Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 3. This is Section E. This is an application topic. Use the fair value hierarchy to determine the classification of a fair value measurement. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time in just 1 hour for free. So again, make sure you go sign up for that. And after you watch that, you're going to want to learn more. So make sure you also check out becoming a SuperfastCPA Pro member. SuperfastCPA Pro members get access to the Pro course where Nate goes super in depth on exactly everything that you're supposed to be doing every day to pass the CPA exams. So you definitely want to check that out. But also SuperfastCPA members get access to the full 10-question versions of these 5-question YouTube videos that I make. Now, with that said, I'm going to be honest, this video is only going to be 5 questions, so the YouTube version and the member version are going to be the same because this is a pretty easy concept, but I still felt like it needed to be covered, so we're only going to be doing 5 questions, and the 5-question video will also be the same for the members, but typically these videos are 5 questions on YouTube, and the member versions are 10 questions, so they can get extra practice. So again, make sure you check out becoming a Pro member to get access to the full videos. With all that, let's dive straight into the questions. All right, here we are at question 1, and as I said before, this is a pretty easy, pretty straightforward topic, but I felt like it needed to be covered, so we're going to do 5 questions on it. This question is pretty easy. How many levels of inputs are there in the fair value hierarchy for fair value measurement? So if you've seen this before, you already know the answer. If you have no idea what this is even talking about, we're going to learn how many there are, and then throughout the rest of the video, we're going to be learning about the different levels and what they mean and what you would use them for when it comes to fair value. So if you know the answer, great. If you don't, then we're going to go ahead and look at the answer together to learn how many levels there are in the fair value hierarchy. All right, the answer is B. There's 3 levels in the fair value hierarchy. Pretty easy, and we're going to dive into each one of them in the next questions. The fair value hierarchy for fair value measurement consists of 3 levels of inputs, level 1, level 2, level 3. These levels categorize the inputs used to measure fair value based on their observability and reliability. So again, that's the basic idea there. We're going to be covering 3 different levels in the fair value hierarchy. Now let's go to the next question to start learning about them. All right, here we are at question 2. And something that we didn't get to do in the first question, but a really good test day strategy is to read the last part of the question first. And in my videos, I typically bold it. Of course, it's not going to be bolded when you do actual questions, but it's to kind of show you what you're supposed to be looking for. You want to read the last part of the question first because it will give you context for what you're dealing with in the rest of the question. And it might seem kind of useless or silly when you're doing a whole bunch of questions that are the exact same, but it will help so much if you are in this habit for test day, because on test day, you have no idea what you're going to be seeing. You could see 50 different topics in the multiple choice questions, and to give yourself that extra help, that extra quickness in answering the questions, read the last part of the question first so you know what you're dealing with. So what level of input is used in this scenario? Let's go up to the top. An investor is valuing shares of a publicly traded company listed on the New York Stock Exchange. The valuation is based on the closing stock price published on the exchange at the measurement date. So what level of input is this? If you have no idea, like you've never seen this before, again, that's okay. We're using these questions to learn the material. But if you know the answer, that's great. We're going to go ahead and look at it together to figure out what level of input this is. All right, here we are. The answer is A. This is a level 1 input. So we're going to learn what level 1 inputs are right now. Level 1 inputs are quoted prices in active markets for identical assets or liabilities that the entity can access at the measurement date. So this is data that is immediately accessible. It's identical to what you're dealing with, and it is an active market. Things are happening right now. That's a level 1 input. In this scenario, the closing stock price on a major exchange like the New York Stock Exchange is a quoted price in a very active market, and it's you can easily have identical assets and liabilities in that kind of a market because you're dealing with stocks. So that is a level 1 input. These inputs are considered the most reliable and objective in the fair value hierarchy. So if you can, you want to be using level 1 inputs for the fair value measurements. Keywords, active and identical. So that's a level 1 input. Let's go to the next question to learn about the next input. All right, here we are at question 3. Which of the following describes a level 2 input? So let's read through these. A, quoted prices for identical assets traded on the New York Stock Exchange. B, appraised value of a private company's intangible assets based on management's assumptions. C, interest rates for similar loans observed in an active market, adjusted for differences in credit risk. Or D, historical cost of equipment purchased several years ago. So out of all these, what's a level 2 input? Again, if you have no idea what we're dealing with here, we're going to learn what that is in the explanation. So let's go ahead and look at the explanation to learn what a level 2 input is. All right, the answer is C. So the level 2 input out of all these is the interest rates for similar loans observed in an active market adjusted for differences in credit risk. So let's dive into what a level 2 input is. It's obviously different from level 1. Level 2 inputs include observable inputs other than quoted prices for identical assets or liabilities, because that would make it level 1. These inputs may involve quoted prices for similar assets or liabilities in active markets, or inputs derived from observable market data, such as adjusted interest rates. So kind of the difference there is this is for similar assets, or it's for observable things, like things you have to kind of go look for yourself, but it's there to observe. Whereas with level 1, the information is immediately available. You don't have to go like figure it out or search for it. It is available. You can see the data that you need. Whereas with level 2, it's specifically for similar assets, or sometimes it can be for identical assets, but in an inactive market. So that's what level 2 is. Option C reflects a level 2 input because it uses observable market data with adjustments, and you might have to adjust things with level 2 input. Options A and D do not qualify as level 2, and option B reflects a level 3 input based on unobservable assumptions, and that gives us a little bit of a hint for what a level 3 input is about. Level 1 would have been A, the quoted prices for identical assets traded on the New York Stock Exchange, and D also would probably be something more like a level 3 input. So again, difference here, level 1, identical in an active market, and the information is readily available immediately. Level 2, more like you have to observe it. It might be in an active market, but it would be for similar assets, not identical, or it might be in an inactive market for identical assets, but again, it's an inactive market. So level 2 is not quite as good as level 1, but it's still better than level 3. Now let's go to question 4 to learn what level 3 inputs are about. All right, here we are at question 4. What level of input is used in this scenario? So let's go up to the top. A company is valuing a custom-built piece of machinery that has no active market. The valuation is based on a discounted cash flow model using management's projections of future cash flows and a discount rate developed internally. So, you already know the answer because we've dealt with 1 and 2 so far. You probably can guess this is level 3. So let's go ahead and just look at the answer since you probably already have a good guess, and let's learn what level 3 inputs are about. Okay, here we are. The answer is C. We knew it was level 3 just based off of the progression of this video, but let's learn what level 3 inputs are. Level 3 inputs are unobservable inputs used when observable inputs are not available. These inputs rely on the entity's own assumptions about market participation assumptions. In this scenario, the valuation of the machinery is based on management's internally developed projections and assumptions, making it a level 3 input. These inputs are typically used for unique or illiquid assets where market data is unavailable. So again, level 3 compared to level 2, this is unobservable inputs, and it has to do with assumptions. They're kind of making estimates. They're using their own internal information rather than observable market data. So that's a level 3 input compared to level 2, where you have observable market data and you might have similar assets or things like that. And then of course there's level 1 where you have identical assets in an active market. So those are all the differences between the 3 different levels. So let's do one more question just to kind of make sure this all makes sense, and then we'll finish the video. All right, here we are at question 5. What is the correct level of input for each asset? So we're dealing with 2 of them here. Let's go through this. A company is preparing its financial statements and needs to measure the fair value of 2 assets. The first asset is a company's investment in a publicly traded stock, and it's valued using the closing price from an active exchange on the measurement date. And then there's 2, the company's office building is valued based on recent sales of comparable buildings in the same area, adjusted for differences in square footage and condition. So based on what we learned in the previous 4 questions, really the previous 3 questions, what is the level of the first asset and what is the level of the second asset? I think based on what we learned, you probably should know this already without even having to think too much. But if you need to, pause the video, think through this, and when you're ready, come back. We will look at the different levels for these 2 different assets. All right, here we are. The answer is A, that asset 1 would be a level 1 input, and asset 2 would be a level 2 input for the fair value measurement. So let's walk through this. Asset 1 is valued using quoted prices for identical assets in an active market, which qualifies as level 1 input. And keywords active plus identical, and we're going to talk a bit more about that in the pillar topics. Asset 2 is valued using observable inputs, so that would be like recent sales of similar properties with adjustments for differences, making it a level 2 input. Remember, level 2 inputs involve observable data that require some level of adjustment but are not reliable as level 1. And then finally, we didn't even have any level 3 inputs in this question, but remember, level 3 inputs would involve unobservable data, such as management's assumptions, which do not apply in this case. So we've learned pretty quickly what the different levels are about. So to finish out this video, let's do one more part of the SuperfastCPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up through the questions. You've seen 2 or 3 questions trying to teach you what a level 1 input is in maybe some different situations. Or again, you may see 2 or 3 questions trying to teach you what a level 2 input is in different situations. Again, these are the things that you notice throughout the questions that pop up more frequently than other things. So you take a moment, write down these pillar topics, these important things in your own words so that you know them for test day. Let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just talk about each one of these. Level 1 inputs. Remember, level 1 inputs are quoted prices in active markets for identical assets or liabilities that the entity can access at the measurement date. These inputs are the most reliable and require no adjustments because they reflect directly observable market data. And examples of this, something that you'll probably see is stock prices on a major exchange. And something I wanted to do with these pillar topics, and this is something you can do yourself when you are dealing with things that are a bit more conceptual. Here's the keywords that you want to look for when you see a level 1 input. Active and identical. So you can see active in the level 2 inputs. So that's why you also want to look for identical. And frequently a stock exchange is going to be a level 1 input. Now let's go to level 2. Level 2 inputs include observable inputs other than level 1, such as quoted prices for similar assets or liabilities in active markets, or data from less active/inactive markets. These inputs require adjustments to reflect differences in characteristics between the observed data and the asset or liability being measured. And examples of this would include adjusted market interest rates or comparable sales data for real estate. And again, keywords for this is observable, so you're going to have to go observe the data, similar, adjustments, and an inactive market, because you can have level 2 inputs for identical assets, but in inactive markets. So again, observable, similar, adjustments. You're not going to be seeing similar for level 1. You're only going to be seeing similar for level 2. And then let's talk about level 3. Level 3 inputs are unobservable and rely on the entity's own assumptions or internally developed data, used when observable market inputs are unavailable. These inputs often involve valuation models, such as discounted cash flow analyses, and reflect significant management judgment. Examples include valuations for unique or illiquid assets. And again, keywords here are unobservable, assumptions, internally developed, no market data. So level 1, that's the best thing. That's what you want to be looking for. That's for an active market where you can see identical assets or liabilities. Level 2 is less good, not quite as good as level 1, but it's still better than level 3. That's where you have to find observable data. You're looking for similar assets. You might have to make some adjustments, and it could even be in an inactive market. And then finally, again, level 3 inputs. These are unobservable. You don't have any market data to look at. You have to make assumptions or guesses. You have to kind of use your own internally developed models to figure out what the fair value of this object is. So those are the 3 different levels of the fair value hierarchy when you are doing fair value measurement. And those are the pillar topics. And that's the end of this video. Again, we are only doing 5 questions this time. We're not doing another 5 questions for the member version. But with that said, just a reminder, most of the time there is a 10-question version of each of the YouTube videos where I go over more questions with the pro members of SuperfastCPA, and they can watch that in the SuperfastCPA Pro forum. So if you like this and you like our other products, make sure you check out becoming a SuperfastCPA Pro member. And the easiest way to do that, the easiest way to get started with SuperfastCPA is to go to SuperfastCPA.com and check out our free 1-hour webinar training. We will teach you in 1 hour for free the key concepts that you need to be applying to pass the CPA exam. And once you watch that, that will make it easier to become a SuperfastCPA Pro member. I hope this was helpful. If you liked the video, make sure to like it and leave a comment, and I will see you in the next video.